Welcome, and thank you for joining me for this weekly episode of the Market Whispers podcast. I am your host, Beachman, and I am super excited to have you here today. Today is Friday, May 10th. Now, right off the bat, I must clarify that I am not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes a month. My paid subscribers know the value that they get from my research, from my writings, from my market analysis, from the active chat line during market hours, and from this podcast. Now, I've mentioned this before, but I'm making a last call announcement here. I'm currently running my best sale of the year, my Mother's Day sale. This is the best pricing that I give out for my annual subscription package, and it only comes around once a year during the Mother's Day week. So last call for my Mother's Day sale. If you are a long-term investor and parent like me, you have multiple things competing for your time and attention. You would like to manage your personal finances effectively, while investing smartly to build wealth and to fund your life's goals. But the last few years have amplified the volume and the amount of noise that is being thrown at us. Financial information noise. So much information overload, so many differing opinions, way too much confusion. And this generally leads to either inaction on our part or way too much action, way too much trading. And that often results in the loss of opportunity to build personal wealth for the long term. Through this newsletter and my Substack, I'm trying to cut through the crap that's out there, to give you the straight story, to share some of my opinions, to describe my simple yet effective approaches to personal finance and investing, and ideally to lead you, to draw you into a conversation and learning about these financial matters. I strive very hard to keep my writing brief, actionable, and to the point so that you can digest it in a few minutes. I do not write reams of pages on earnings reports that glaze your eyes over. I don't just report the numbers without putting context behind them. I don't just copy and paste quotes from earnings calls. That's just lazy reporting in my mind. I don't write long technical white papers that look good on paper but do very little in terms of really increasing your knowledge about these companies. Throughout my entire professional life, I have worked hard to improve how I communicate and communicate effectively. My number one goal is to inform you and to increase your understanding so that you can make smarter financial decisions on your own. I use forward-looking and backward-looking trends as I analyze company fundamentals. Many investors typically get narrowly focused on just the most recent quarterly earnings report and the next quarter's estimates because that's what the financial media likes to tell us about. That's what they focus on as well. And this leads to short-term investing decisions that typically result in muted portfolio returns. I use longer-term trends, both forward-looking and backward-looking trends. For example, in late 2022, my NVIDIA earnings reports informed readers about how the company was undergoing a major product reset and a major pivot in their business direction. My trend finders told me that it was not the time to sell NVIDIA when everybody was super uber bearish about the company. It was in fact a good time to buy the stock, and that's exactly what I did. I got some really good prices on NVIDIA in the October-November 2022 timeframe. And since then, NVIDIA has risen over 330%, including an all-time high that it logged earlier this year, over $1,000 per share. Now, I do the same thing every quarter, quarter over quarter. I identify which stocks are pivoting out of their macro challenges and have the best potential for higher business growth going forward. And these are the companies that I try to highlight for my readers. And these are the companies that I try to buy right now before the rest of the world identifies them as future winners. I focus my work on growth investing, tech investing, AI investing, personal finance, early retirement, and of course macroeconomics, because that colors everything that happens in the financial markets today. Remember, my Mother's Day sale goes away in a few days. And by the way, Mother's Day is this Sunday, May 12th, in case you forgot. So take some time to call your mom or visit your mom. Reach out to all the mothers in your life to thank them for everything that they do, because they really deserve our gratitude and our love. Now, let's get on to the meat of this episode. Well, it's been a relatively quiet week in the markets this week, kind of sandwiched between last week's lower than expected, weaker than expected US jobs report and next week's inflation reports. Next week, we're going to get both the retail and the wholesale inflation reports for the US. So this week was kind of a quiet week. The Dow Jones index rose 0.3% and it wrapped up its 8th consecutive winning session, its best week of 2024. The S&P 500 climbed just about 0.16% today, and the Nasdaq 100 gained 0.25% today. All the major averages wrapped up this week on a high note. The Dow Jones gained over 2% for the week. This was its best week since December last year, and its 4th positive week in a row. The S&P 500 and the Nasdaq both posted their 3rd consecutive winning weeks. The S&P 500 rose 1.85% for the week, and the Nasdaq gained about 1.14% for the week. So far this year, the S&P 500 has been leading actually all of the major indexes. So far this year, the S&P 500 has gained almost 10%. The Nasdaq is next, gaining almost 9% so far this year. The Dow Jones Industrial started slow, but it's been catching up fairly quickly over the past few weeks. It is up about 5% for the year. And the small cap index, the Russell 2000, is just about 4% up for the year. In terms of macro updates this week, like I said, there wasn't much happening on the macro front. Just a lot of Fed speeches that surprisingly, actually, to me, it was surprising that they didn't move markets that much. So maybe, I don't pay attention to these Fed speeches, but the fact that markets didn't move tells me that there wasn't really anything surprising or vastly different from what Chair Powell has already told us the prior week. On Wednesday, 8th of May, Sweden's central bank executed their first interest rate cut, and they project to make 2 more interest rate cuts during the second half of the year. Inflation continues to moderate in Sweden, and therefore they're making these rate cuts early. Remember, we talked about central banks around the world starting their rate cut cycle much earlier than the US Federal Reserve Bank. The Swiss National Bank, they cut rates in March. So Sweden is now the second advanced economy to cut rates and ease their monetary policy. Now, net, this puts even more pressure on the European Central Bank to cut rates at their next meeting, which is in June. There's also pressure now on the UK Central Bank to make their own rate cuts also in the month of June. Now, in the past, foreign central banks have often followed the US Fed's lead, but this time they are not waiting around for the Feds to cut rates before they do it themselves. These European central banks have started cutting interest rates, and the Fed is probably going to be the one following them in 2024. And oh, by the way, if you were curious about rates in some other international markets, South Africa and Brazil, their interest rates right now are some of the highest, right around 10%. Remember, the US is about 5.25%. Well, in South Africa and in Brazil, they've got interest rates right up at 10%. In Russia's interest rates now are at around 14%. Peru cut their interest rates. Peru has been cutting their interest rates now for 8 meetings in a row. They have executed 8 rate cuts already. Brazil, even though their rates are up there at 10%, they themselves have cut rates for 7 meetings in a row now. So this time is different. This financial easing cycle is different. And the US Feds could be cutting rates later than some of these other central banks. And what does that mean for us investors here in the US? As I mentioned last week, this puts upward pressure on the US dollar. Remember, investments follow the value of the currency. So investments pour into markets that have stronger currencies and higher interest rates. And therefore, if these other central banks are going to be cutting their rates around the world, then more capital is going to flow into the US dollar. The value of the US dollar is going to increase, so that foreign exchange value of the dollar is going to increase. This puts more pressure on international sales for US companies. US companies that sell their products and services around the world, their sales now are worth less because the US dollar is worth more. And this in turn puts pressure on the earnings for these companies, just like Starbucks recently announced during their Q1 earnings season. And this in turn will put pressure on the US's GDP growth for 2024. As long as this difference or this lag in our interest rate policy exists, the lag between the US interest rate levels and foreign rate cuts, as long as this difference exists, GDP growth will be under pressure due to a more expensive US dollar. We talked about the GDP forecast for the rest of the year in 2024. Q1's latest GDP forecast came in at 1.6%. This was much lower, almost 50% lower than what analysts were expecting. Q2's GDP forecast is now 1.9%. Q3 GDP in the US is expected at 1.8%. And Q4, which is typically the strongest quarter in the US, is expected at only 2%. So the full year 2024 GDP forecast for the US is now much lower at only 1.8%. But all that said, the US economy is still chugging along. The US economy still remains resilient. Why is that so? Well, we learned this week that bank reserves are holding about $3.4 trillion in savings. So while consumers are scaling back their spending, they are also saving at much higher rates. Financial conditions in the US are quite conducive today to business growth. These savings are flowing into the stock market in terms of investments. They are flowing into the private investing or private equity markets. That's where a lot of small cap companies are getting their liquidity. So there is a lot of liquidity still in the system, and this is how the US economy is staying resilient and growth continues to show up. The US Feds recently, in their most recent press conference, they announced that they were tapering their QT or quantitative tapering program. They were going to reduce their QT program by about 35%. This again increases liquidity in the financial markets to at the rate of about $35 billion per month. And so financial conditions in the US continue to be strong, and that is being reflected in the better than expected Q1 earnings reports that we have been receiving. The bulk of US companies that have now reported their first quarter results are showing that profit growth is picking up. So far, more than 400 S&P 500 companies have reported their Q1 earnings, and 79% of them have beat earnings estimates by an average of almost 9%. This is data according to FactSet, right? So earnings per share for the companies in the S&P 500 index now looks to be on track for increasing by about 5.4% for Q1 as compared to a year ago. This is way better. So this 5.4% growth in earnings for the S&P 500, this is much better than the 3.4% that analysts were expecting. And this marks the strongest growth that we have seen in nearly 2 years. Okay, this is the strongest growth that companies have delivered in nearly 2 years since 2022. Analysts are now expecting the second quarter earnings to gain around 9.8%, double of what we have seen in Q1. The top 5 contributors to earnings growth for the S&P 500 in Q1 were, not surprisingly, several of the Mag 7 companies. Nvidia is supposed to deliver solid earnings growth. Alphabet, Amazon, Meta, and Microsoft have all 4 reported better than expected earnings growth for Q1. If we exclude these 5 companies, Okay, remember I said so far earnings growth is averaging about 5.4% for Q1. But if we take out just these 5 companies, then earnings growth for Q1 would be a measly negative 2.4%. So it would have been an earnings decline of negative 2.4% if these 5 companies had not delivered very, very strong results. Some of the key earnings reports we received this week. Just this morning, TSMC, the Taiwanese chip maker, reported that their revenue in April had soared 60% year over year. The demand for AI chips remains very, very strong. Their revenue from January through April is already up 26% year over year. ARM, the British AI chip designer that recently IPO'd to much fanfare, also recently reported fairly strong earnings in Q1. On the other hand, Airbnb, the travel company, while they reported a Q1 earnings beat, their quarterly forecast for Q2 disappointed investors and the shares dropped significantly after hours. Now, Airbnb did tell investors that their Q3 is expected to be very strong due to the Summer Olympics in Paris. Beyond Meat, the plant-based meat company, reported a decline in Q1 revenue, and their shares dropped negative 14% after they reported. Maybe they'll have an opportunity to pick up more sales, better sales in Q2 as we get into the summer. Redfin is a real estate company. I watch that company very closely as a barometer of the health of the real estate market. Redfin reported their first quarter results that exceeded expectations. So despite the challenges in the real estate market, they have diverse revenue streams that cover many aspects of real estate. And these diverse streams, as well as effective cost management, contributed to their superior financial performance in Q1. Disney's stock was down negative 10% after they reported their Q1 results. They reported losses after delivering profits in Q4. So this kind of ties back to what Airbnb also told us about weakness in the travel sector. Now, Berkshire Hathaway, they held their annual shareholder conference this past weekend in Omaha, Nebraska. And during that meeting, they announced that they have a record $189 billion of cash on their balance sheet. Wow, $189 billion of cash on their balance sheet. Now, if you remember, 2 weeks ago, Apple told us that they had $162 billion of cash and short-term investments on their balance sheet. Microsoft has $80 billion on their balance sheet and Amazon has $85 billion on their balance sheets. So these large companies have a lot of cash. Now, coming back to Berkshire, when he was asked why he didn't invest all this money, all this cash on the balance sheet, here's what Warren Buffett said. These are his exact words, and I quote, "I don't think anyone at this table has any idea of how to use $189 billion in cash effectively, and therefore, we don't use it. We only swing at pitches that we like, and today, things are not attractive enough. I don't mind that at all given current conditions to keep building our cash position." I mean, when I look at equity markets and the composition of what's going on around the world, we find cash quite attractive. So this is what Warren Buffett says. He says, I've got all this cash on my balance sheet, but valuations are very high today, and I don't find good investment opportunities as I look around the world. And therefore, we are much happier just holding on to the cash. Now, the question for investors like you and I is too much cash on the balance sheet of a company a good thing or is it a bad thing? I mean, is there anything such as having too much cash on your balance sheet? Now, we've talked in the past about how these mega cap companies are using the billions of dollars of cash on their balance sheet to earn a lot of interest income on this cash. And this interest income is going towards boosting their earnings and their profits and even their cash flows. Now, you and I, we earn about 4 to 5% on our savings account. We put money in CDs today and we're getting 4 to 5%. The mega caps are also earning interest at about similar rates, maybe slightly higher rates as well, because they got a lot more cash to put in. Now think about that, right? If you earn about 5% on $160 billion, right? You're earning $8 billion a year just by parking your cash somewhere. And this is a great thing for boosting earnings in high interest rate times like this. But as the US Feds cut rates as we get into the second half of 2024, as we start seeing rate cuts from the US Feds, that interest income is going to shrink. So what should a company like Berkshire or Apple do with all this cash? Well, one thing that Apple is doing is they are returning cash to the shareholders in the form of buybacks and dividends. Recently, Apple announced in their Q1 report, they announced that they are going to buy back a whopping $110 billion of their shares in the open market. They're going to retire $100 billion worth of their shares in the open market by deploying some of that cash that they hold on their balance sheet as well as that they generate on an annual basis. So far in the past year, they have repurchased about $82 billion of their stock. So Apple has been buying back their shares at around $80 to $90 billion per year. And that translates to a retirement of about 4 to 5, sometimes even 6% of their shares. And this is how they're returning money back to their shareholders. Apple's market cap has increased about 230% since 2018, right? So it has 3.3x since 2018. And over that time frame, they have reduced shareholder dilution by about 28%. Since 2018, Apple has returned over $550 billion to their shareholders in the form of share repurchases and dividends. Now, stepping back and taking a look at the top US companies in the S&P 500 as a whole, right? Stepping back, these top US companies are arguably the best 500 companies in the world, and they are feeling pretty good about their current business prospects looking forward over the next 3 to 4 quarters. The first quarter earnings season turned out to be better than Wall Street analysts expected, and companies are stepping up repurchases of their own shares. This is how they're giving back to their shareholders. S&P 500 companies have reported buying back about $181 billion of their shares just in Q1. In Q1 itself, these S&P 500 companies have bought back or retired $181 billion of their shares. And this is up 16% as compared to this time last year. Looking forward, Goldman Sachs estimates that these companies will spend almost $1 trillion on share repurchases in 2024. And this is all great for shareholders. You know, the company that buys back their shares, this is one of the key characteristics that I try to look for as I decide which companies I want to hold, which companies I want to buy and hold in my portfolio. Now, we also have to ask the other question. Are these companies missing out on interesting and strategic merger and acquisition opportunities? Are they wasting this cash that they're generating by giving it back to the shareholders? Are they being too gun shy with acquiring other businesses? Have they done enough of due diligence to find these other acquisition targets? Well, sometimes Wall Street and investors think that Apple is too gun shy with its acquisitions. And I went and took a look at some of the data on Apple's acquisition track record. And Apple has continually and continuously been making surgical acquisitions throughout the last 3 to 4 years since the pandemic. As per research from Stocklytics, Apple has acquired 32 AI startups in 2023 alone. Just in 2023, Apple acquired 32 different AI startups. This is more than any other major tech company that we know of. Apple CEO Tim Cook has said that Apple acquires around 3 to 4 companies per week. Right? This is what he says, 3 to 4 companies per week. This 32 number that I gave you was just AI startups. So if you multiply 3 to 4 companies per week, it sounds like Apple is acquiring at least 100, 150 companies per year over the last 2 to 3 years. It typically focuses its acquisitions on small to medium sized companies. M&A or mergers and acquisitions are very hard for mega cap companies, especially when they try to acquire and digest large businesses. I mean, why is this so? One, it's hard to get a good price. Often these larger companies are expensive for a reason. After all, you're interested in acquiring them because they have something you need or want, and financial markets know this. Those companies themselves know this, and markets can sniff this out, and before you know it, the valuation, either in public or private markets, that's being given to that company you're trying to acquire, the valuation goes up before you can sign on the dotted line and buy that company. The news tends to get ahead of the M&A event. It's really hard for a mega cap company like Apple to control the news flow or the rumor mill, and this often complicates the acquisition process. It is, like I said, harder to integrate larger businesses. There are differences in culture, operations, mindset, employee staff mindset, strategies that the company has been pursuing before you acquire them, their HR practices, and often even their technology stack. And because of these major differences in the two companies, it is difficult to integrate these businesses quickly and effectively and make sure that revenues and sales and earnings don't get hurt, and current customers don't walk away because you haven't done a good job of integrating the company that you're acquiring. Now, when I was in the corporate world, I used to work at a large US national bank. This was around the late 1990s. Now, that was the heyday for bank consolidations, bank M&A in the US. And the bank that I worked for, we used to do about 30 to 50 acquisitions per year. I kid you not. So we had it down to a science in terms of how we integrated the company that we were acquiring, the bank that we were acquiring that particular week. We would focus on our acquisition process, our integration process across 4 dimensions: people, processes, data, and technology. Now, one would argue that these kind of acquisitions are much more difficult to do in product companies, companies that produce widgets. So given that M&A is harder for these mega caps, they continue to collect cash and make fewer and more surgical and smaller acquisitions for now. Apple is Warren Buffett's largest holding. In 2016, Berkshire Hathaway began buying up shares of Apple. Now, this was a surprise to markets and shareholders. I mean, Apple was the exact kind of stock that Buffett and his longtime partner Charlie Munger had long avoided. They were not big fans of investing in technology at that time, but they started buying. In fact, a few years earlier, Buffett had suggested that Apple fit the profile of a stock that one might short. I don't know if you've heard this, but prior to 2016, Buffett had suggested, apparently in a private meeting, that Apple was the type of technology company that one needed to short instead of buying. But by the end of Q3 2018, Apple was their largest portfolio holding, and Apple was in fact about 25% of Berkshire Hathaway's entire investment portfolio by the end of 2018. In dollar terms, this was twice as large as any investment that Buffett has ever made in an investing career. Now, this move has paid off for them in a big way. Today, Berkshire's 6% stake in Apple is worth about $157 billion. So Berkshire Hathaway is sitting on about $120 billion of gains in their Apple holding. So think about it. They bought Apple shares. It only cost them about $25 to $27 billion. And so right today, it's worth $157 billion. So they have 4x'd their investment in Apple since 2016. This is likely the most money ever made by an investor or firm from a single stock. And today, Apple stock continues to grow, and it represents more and a bigger and bigger share of Berkshire Hathaway's stock portfolio. I believe it's almost 50% of their total portfolio today because of how much Apple stock has grown. Talking about fat on the books, Let's talk about GLP stocks. So about this time a year ago, the favorite cocktail party topic of conversation was how much weight so and so has lost using the new GLP wonder drug. These are the new anti-obesity drugs that are on the market, and they seem to be working for a lot of Americans, helping them reduce their weight, helping them to get healthier, also helping them, in fact, to reduce symptoms from other health conditions like blood pressure or chronic heart disease, etc. But unfortunately, it seems that the effects of these drugs are waning. It seems that more and more patients are actually abandoning these wonder drugs. The emerging theme that we're hearing more and more among these patients is, yes, it is a wonder drug, but it's just not for me any longer. And the related stocks for these GLP drugs, the stocks like Eli Lilly and Novo Nordisk, although they have been on a tear since 2023, they are now starting to show some major weakness in their stock chart. These stocks have been flat to lower since February or March of this year. Now, there are several billion dollars of investment dollars chasing these stocks. But the fact that these stocks are no longer going up could be an early sign of a potential problem as an investor. Now, one of the troubling facts is that about 2/3 of those in the US that started taking one of these GLP-1 drugs in 2021 stopped taking them within a year, right? According to industry analysts, these GLP drug users stopped taking these drugs after using them for about a year. Another research study has found that when these patients stop taking the GLP-1 drug, many regain a substantial amount of weight that they lost in the first place with the help of this medication. According to Dr. Cody from Stanford, GLP-1 medications will be helpful to only about a fraction of the 1 billion people globally who have obesity. So it's extremely promising for just a fraction of people around the world that suffer from obesity as a disease. So GLP-1 drugs are not the silver bullet for weight loss that many people or many patients are making them out to be. Other recent research on these drugs have shown that these medications lead to reduction in lean body mass, of which 50% is muscle. So these patients are actually losing muscle tone when they take these drugs on a regular basis. Clinical trials for these medications found that 40% of the weight lost by these patients came from lean mass reduction, from the reduction of muscle mass. According to Sanford Bernstein, cycles of GLP-1 on and off treatment could actually lead to a vicious cycle of more and more fat and less muscle, even though there is overall weight reduction. Now, what does this mean for investors like you and I? Well, investors have been looking to profit from the rise of these weight loss therapies, right? So investors started chasing these stocks like Eli Lilly and Novo Nordisk, and now they have been moving beyond the shares of these drug manufacturers. Investors started pouring money into snack makers and other companies that could flop or flourish depending on whether consumers' habits change because of these GLP-1 drugs. So what's the takeaway for you and I? Well, I believe that prudence and proper positioning sizing is recommended when it comes to deciding to invest or not invest in these healthcare stocks. I mean, healthcare stocks do have a place in an investor's portfolio, but chasing frothy stocks in a FOMO-driven cycle, especially when research is telling us that the results that patients are getting is inconsistent, chasing these kind of frothy stocks can prove very risky. And I believe that savvy investors need to be careful. Even Goldman Sachs recently advised their clients to get out of these stocks. And Goldman Sachs is in fact actively shorting these GLP-1 stocks like Novo Nordisk and Eli Lilly. Let's change directions here a little bit and talk about Bitcoin. A few episodes ago, we talked about the Bitcoin halving event that was coming up in mid-April. Well, the fourth Bitcoin halving event took place in mid-April, and crypto enthusiasts were expecting a rally of sorts for the cryptocurrency. Now, as we discussed a few episodes ago, Bitcoin halving is a scheduled reduction in the amount of new Bitcoin that enters the crypto market. It's intended to protect the cryptocurrency's value by ensuring that its circulation is capped at only 21 million Bitcoin. Now, this halving occurs about every 4 years for Bitcoin, and this time it reduced the supply of new coins that is awarded to miners. It reduced the supply of these new Bitcoin by about half, from about 6.25 Bitcoins to about 3.125 Bitcoins. So investors were expecting that the lower supply of Bitcoin in the open market would lead to a run-up in Bitcoin's price. And this has happened actually at all the other halvings that took place over the last, 10, 15 years. But so far, this Bitcoin halving has been different. Since the April 19th halving, the price of Bitcoin has actually fallen by about 2%. And crypto investors are asking why? What's happening here? Why isn't the value of Bitcoin going up after this halving event? Well, there are a lot of theories out there and nobody knows the real answer. Well, it seems like the recent SEC approval of the first US listed Bitcoin ETFs likely played a role in ensuring that Bitcoin didn't rise significantly after this halving event in April. Now, the spot Bitcoin ETFs, they were certainly welcomed by investors who have collectively poured nearly $60 billion into them since they were approved in January. These ETFs have attracted nearly $60 billion of new investors since January. And the related increase in demand for these ETFs, it drove up the price of Bitcoin by about 50% by mid-March. So between January and mid-March, Bitcoin rose about 50%, but then it dropped about 15% since then in spite of the halving. So maybe too much of a good thing is not that good. These unexpected results remind us that investing in crypto remains risky. It comes with unexpected consequences. The underlying market doesn't always react as we think it's going to react. The underlying crypto market is volatile, it's dynamic. Only time will tell us what's in store for Bitcoin going forward. But one thing is sure, Bitcoin halving doesn't seem to be a sure bet for crypto gains after such an event takes place in the future. Now, before we wrap up this week's episode of Market Whispers, I want to talk a little bit about American exceptionalism. Is American exceptionalism on the decline? Recently, we have heard and read about this a lot. This question comes up a lot, and it comes up especially more so in an election year in the US. Now, Bank of America did some research on this topic recently, and what they found is that no country in the world is as dynamic, resilient, productive, diversified, or wealthy as the US. Now, the recent FinTwit and FinMedia narrative is that America is in decline. But according to Bank of America's research, this is all nonsense when you actually look at the facts. They caution their investors not to get caught up in this negative Nancy talk and exit the capital markets or sell all their investments or try to time the market just because they believe that America is on the decline. Bank of America thinks of the US economy as a hydra-headed $28 trillion superpower that thrives and excels in multiple sectors and activities at the same time. Sectors ranging from energy to entertainment, technology to transportation, agriculture to aerospace, just to name a few. America today has less than 5% of the world's population, but the US accounts for almost 25% of global gross domestic product. So with less than 5% of the population, the US is generating 25% of global GDP. I mean, you pick any sector or activity, and there's a good chance that the US leads the rest of the world in that sector or that vertical. America's entrepreneurial DNA empowers startups, it enables innovation, it fosters competition, it creates immense opportunities, and it challenges incumbents. And in the end, it produces the most dynamic economy the world has ever seen and some of the world's best returns on stock market investments. According to Arbor Data Science, since 2013, the US has nurtured over 5,500 AI startups, and it has nurtured these AI startups through venture funding. China is second with less than 1,500 AI startups, and the UK is a far third with less than 700 startups. So the US is this engine of AI innovation, creating almost 3 times, more than 3 times, in fact, more than 3 times the AI startups as compared to any other country around the world. According to The Economist, they noted recently that the US continues to put the rest of the world to shame. The US economy has expanded nearly 8% in real terms since 2019, since before the pandemic. This is more than twice as fast as the Eurozone and 10 times as fast as Japan. So significantly faster than any other economy around the world. So don't believe, don't buy into, don't believe this America defeatist narrative if you hear about it, if you read about it. Because if you do, as an investor, you're shortchanging your opportunity to invest in the most dynamic economy in the world. You might be shortchanging your own portfolio investments if you take action, investing actions based on some of this negative Nancy narrative. The US financial industry is the largest, most liquid, and most complex in the world, with a well-established stock market culture that drives more IPOs, more equity financing, more startup funding than any other country in the world. And this is exactly the type of market that savvy investors like you and I want to put our money to work. So, what's coming up in the markets next week? As I mentioned earlier, we are going to have a busy week next week. On Tuesday, May 14th, we get the NFIB Small Business Index report for the month of April. This is a leading macro indicator that I closely follow because it tells me about the health of the small to medium-sized business community. On Tuesday 14th, again, we will get the PPI, or the wholesale inflation report for April. On Wednesday, May 15th, we get the CPI, or the retail inflation report for April. I think markets are going to be closely watching both the wholesale and the retail inflation reports to try to get some clues as to whether the US Feds are likely to cut rates sooner rather than later in 2024. And then on Friday, May 17th, we have the monthly options expiration for the month of May. As I mentioned earlier, I always expect some volatility in markets on that Wednesday and Thursday. So look for that as well. And as we get into Friday, some of that volatility should be behind us. So that's all I have for this edition of the Market Whispers podcast. Do drop me a comment or question anytime. I always love to hear from you readers. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest. For life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.